Imagine planting a tree. You water it every week. You protect it from pests. You check on it constantly. A month passes. Nothing. 6 months pass. Still nothing impressive. A year passes. It's barely taller than when you planted it. Most people would start wondering if something is wrong. Some would stop watering it altogether. And that's exactly how most people treat investing. They begin with excitement. A few videos, a few podcasts, maybe a new brokerage account. They buy their first investments. They imagine future wealth, future freedom, future security. And then reality arrives. The portfolio barely moves. Some months it falls. Some years it goes nowhere. And before the most powerful part of investing has a chance to appear, they quit. Not because investing doesn't work, but because it doesn't work the way they expected. The strange part is that many people quit at almost the exact moment when patience starts becoming valuable. And by the end of this video, you'll understand why. Investing isn't as difficult as most people think. The challenge isn't picking stocks, or understanding charts, or predicting the economy. The real challenge is surviving the long period where it feels like nothing is happening. And that's where most investors lose. Not to the market, to themselves. Right now, millions of people are investing for the first time. Retirement accounts are easier to access than ever. Investment apps fit inside a pocket. Information is everywhere. Yet despite having more access than any previous generation, many people still struggle to build wealth through investing. Why? Because the human brain wasn't designed for long-term investing. It was designed for immediate feedback. Think about almost everything else in life. You go to the gym, you eventually see physical changes. You study for a test, you receive a grade. You work a job, you receive a paycheck. Effort produces visible results. The relationship feels obvious. Investing is different. The effort happens first. The reward often arrives much later, sometimes years later. And that's psychologically uncomfortable. Let's imagine two investors. Both invest $500 every month. Both start at age 25. Both choose broadly diversified investments. Their strategies are nearly identical. For the first few years, their results look almost disappointing. After 1 year, their account doesn't seem life-changing. After 3 years, still not impressive. After 5 years, progress feels slow compared to the effort. This is the moment many people begin questioning everything. Maybe investing doesn't work. Maybe they chose the wrong investments. Maybe they should wait until markets improve. Maybe they should focus on something else. And that's when the first investor quits. The second investor continues, not because they're smarter, not because they're wealthier, but because they understand something the first investor doesn't. The market rewards time far more than effort. That sounds strange. Most areas of life reward effort directly. Investing rewards endurance. The reason lies in a force that's often described as the eighth wonder of the world: compound growth. Most people hear that phrase and immediately stop paying attention. It sounds like something from a finance textbook. But compound growth is actually simple. Imagine earning returns not only on your original money, but also on the returns that money previously generated. Your gains begin generating their own gains. Then those gains generate additional gains, and the process repeats. The problem is that compound growth doesn't move in a straight line. It behaves more like a snowball rolling down a hill. At the beginning, the snowball barely changes. You push and push and push. It feels almost pointless. But eventually, something changes. The snowball becomes larger. Now every rotation collects more snow than the last. Growth accelerates. The same thing happens with investments. Early progress looks insignificant. Later progress can become dramatic. And this is where many investors make a costly mistake. They judge investing during the slowest phase. Imagine investing consistently for 10 years. The account has grown, but not enough to completely transform your life.
Now, imagine stopping. You walk away just before the period when the largest dollar gains often begin appearing. You endured the hardest years, then missed the most productive ones. It's similar to leaving a movie 20 minutes before the ending. You've invested all the time, but never see the payoff. What's fascinating is that market downturns make this behavior even worse. Because people don't quit when everything is going well. They quit when fear arrives. A recession appears. Headlines become negative. Stock prices fall. Experts disagree. Social media predicts disaster. And suddenly, investing feels dangerous. Yet history shows something interesting. Many of the strongest periods of market growth have occurred after some of the most frightening periods of decline. The problem is that nobody knows exactly when those recoveries will begin, which means investors face an uncomfortable choice.
Either stay invested during uncertainty or leave and hope they can return at the right moment. Most choose the second option. Unfortunately, timing the market sounds easier than it is. Let's say someone exits after a major decline. Now they need to answer two questions correctly. When should they leave? And when should they come back? Getting one answer wrong can significantly reduce long-term returns. Getting both wrong can be devastating. The irony is that many investors who fear losing money end up creating larger losses by constantly reacting. They move in and out, chasing certainty. But certainty rarely exists in investing. There's another reason people quit too early. Comparison. Someone online doubles their money. A friend claims they found the next big stock. A headline celebrates overnight success. Suddenly, steady investing feels boring. The problem is that wealth is usually built through boring processes. Consistency isn't exciting. Diversification isn't exciting. Patience isn't exciting. Yet those are often the exact behaviors that survive long enough to benefit from compounding. The market has a peculiar way of rewarding actions that don't feel rewarding in the moment, and punishing actions that feel good immediately. Checking your portfolio every hour feels productive. Often it isn't. Making dramatic changes feels proactive. Often it isn't. Staying invested feels passive. Yet that quiet decision can sometimes be the most powerful financial choice a person makes. Here on Wealth Undistracted,
We spend a lot of time talking about systems because wealth is rarely created through isolated decisions. It's created through repeated behavior.
And investing may be the clearest example of that principle. Most successful investors don't win because they're financial geniuses. They win because they remain in the game long enough for mathematics to begin to work on their behalf. That sounds simple, but simple and easy are not the same thing. Anyone can understand the idea of long-term investing. Far fewer can tolerate the years where progress feels invisible. That's the hidden test. Not knowledge, not intelligence, but patience. The uncomfortable truth is that investing often feels least rewarding right before it becomes most powerful. The tree still looks small. The snowball still looks insignificant. The account still feels underwhelming. And that's exactly when many people stop. Not because the strategy failed,
Because they couldn't yet see the result. The market doesn't care about excitement. It doesn't reward urgency. It doesn't respond to impatience. But over long periods of time, it has repeatedly rewarded those willing to stay when staying feels difficult. And perhaps that's the biggest misunderstanding about investing. Most people think success comes from finding the perfect investment. More often, it comes from surviving long enough for an ordinary investment to do something extraordinary. Which raises an uncomfortable question. If the greatest threat to your investments isn't the market, could it be your own need to see results too soon? Disclaimer: this video is for educational purposes only and does not constitute financial advice. Please consult a qualified financial advisor for advice specific to your situation.